The Wall Street Journal's Nick Timiraos writing this: the central banks usually prefers to move in increments of a quarter point, but this time is complicated as the goal is to preserve solid job market now that price pressures have cooled. Nick Timiraos joins me right now, the Wall Street Journal's chief economics correspondent and the author of $1 Trillion Triage. Nick, great to see you. Thank you so much for being here. And you've made the case in the Journal as well as in your tweet yesterday that you could make the case for both sides. Break down for us cutting 25 basis points versus 50 basis points.
Well, thanks for having me, Maria. The case for 25 is that, the economy is fundamentally fine. You don't see anything terribly alarming right now. And changing direction on interest rates is a big move. So start smaller, and then if you think you need to do more later, you can do more later. The case for 50 comes down to what Fed officials call risk management, with interest rates now at a level that almost everybody thinks is restrictive. You are above the neutral rate. And with the economy pretty much in a place where you want it to stay, you want to be closer to neutral. So risk management says you ought to move closer to neutral sooner. Former Dallas Fed President Rob Kaplan told me, he told Cheryl last week, that he thinks about it in terms of minimizing regret. What are you more likely to regret? Cutting by 50 and the economy's fine, and at your next meeting in November you say, well, that interest rates are not too low at 4.9%. Or if you cut by 25 and then things cool down a lot more and you say, oh, geez, we're behind the curve. And so I think the case for 50 is really one of what are you going to regret more?
Yeah, but I mean, if you've got a 50 basis point cut in September, just less than 50 days away from an election, does the Fed get criticized for trying to help one side, Kamala Harris's side, by cutting rates aggressively?
I think the Fed is going to get criticized no matter what it does. And so the focus is on getting it right. If the economy is slowing a lot and let's say Donald Trump wins the election and then the Fed has to cut interest rates a lot, that could end up looking political in hindsight, too. Oh, well, they waited until after the election. They didn't do what they should have done. And at the town hall last night in Flint, Donald Trump said, the fact that the economy might not be so good, the Fed is cutting because the economy might not be so good.
Right. That's
true. So I think, you can play this anyway on the politics.
What about these 3 Senate Democrats, including Massachusetts Senator Elizabeth Warren? She sent a letter to Jay Powell, and she's demanding they cut rates by 75 basis points. She says waiting this long to cut rates has threatened the economy and left the Fed behind the curve. House Financial Services Chairman Patrick McHenry blasted those lawmakers. He said that they're demeaning their role by trying to influence the Fed and that the central bank should act in the way that the data indicates. Nick, do you have a sense of whether or not the Fed has missed their opportunity and is, in fact, behind the curve, the way Elizabeth Warren charges?
Well, the comments from McHenry, that was from an interview that I did with him yesterday, and he basically said the Fed should do what it has to do, period. And I think that's what the Fed is going to do here. I think the reason this is a close call today is because, there was a debate at the last meeting in July about whether they should cut. They obviously decided not to cut interest rates then. And then 2 days after that meeting, you got a job report that was much softer than what almost anybody had been looking for. I think if they had had that number in front of them at that meeting, they probably would have cut interest rates. You don't get mulligans in central banking. But so there's an argument there that says, well, you would have been 25 basis points lower in July if you had known what was coming, and you'd probably be 25 basis points lower today, even if you had moved then. I think that's another argument for being, 50 basis points lower today.
Tom Lee from Fundstrat has been making the case that this is all noise, that the Fed put is in, the Fed put is back, and that's where things are going. And so any reaction after the number right away is going to be just noise. Give us your sense of what you want to listen for. What's most important that we should be focused in on when Jay Powell speaks today at 2:30 in that press conference?
Well, the quarterly interest rate projections at this meeting will be interesting because this is calendar-based guidance they provide. They're writing down how many rate cuts they expect over the course of the year. But after today, there's only 2 more meetings, Maria, so they're pretty much telling you what they think is likely to happen in November and December. And so if they cut 25 and they put down 25 more in November and December, that'll be a signal. If they do 50, do they still see 25 more in November and December? That's, that'll be kind of the first thing that people look at 2 p.m. Tom's right. At the end of the day, people are not going to remember this meeting if the economy, slides off the cliff here, or if Jay Powell sticks the soft landing. And so I think, in the long run, it's really about can you succeed in your goal here of bringing inflation down without a recession.
So is that your barometer, inflation and where it is? Because there's also this jobs number that, is also debatable. I mean, look, you had the July and August jobs report showing a labor market that is slowing. If it continues to weaken, how would you look at the economy today?
Well, I think the puzzle right now is the hiring rate is very low. The hiring rate is close to it's close to where it was 10 years ago. Hiring has slowed down a lot, but the unemployment rate has not gone up, quite so much because layoffs are still low. So you see these announcements now from companies like Amazon telling workers to come back into the office 5 days a week. And I think you have to wonder, is that sort of the first step towards letting people go? This is a non-wage benefit that companies are taking away. And it could be a sign that says, look, we think we overhired. We think we're overstaffed. We don't want to fire people, but we want you to come back into the office because we don't really care if some people leave the company right now. I think that's a question is, what is happening to labor demand? A body in motion stays in motion. The labor market has been cooling. And so what is going to stop the labor market from cooling? Yeah,
that's a great point. Nick, if this is the beginning of a string of rate cuts, how long would you expect that to last? I mean, let's say, the betting on Wall Street that we get 3 cuts this year. How many cuts next year? What are you expecting how long this string of rate cuts or this next cycle would last?
Well, I think it really does depend on what happens in the economy with employment and inflation in particular. If you were to see another upside surprise to inflation, or if there's evidence that the neutral interest rate is higher, what is a normal interest rate in this economy? Is it 3%? Is it 4%? That's going to play a big role in where the Fed goes. If inflation picks back up, then the Fed might have to slow walk these cuts. On the other hand, if inflation continues to make the progress that it has been making towards the Fed's 2% goal, and if hiring continues to slow, and if layoffs pick up, then the Fed will cut more. And so I think it just comes down to what happens in the economy. We will have to watch.
Yeah, that's why we're watching every data point that comes out and have all hands on deck around it. Nick, it's good to see you as always. Thank you so much.
Thanks for having me.
All right, Nick Timiraos, Wall Street Journal. Stay with us. We'll be right back.